Much has been said about the rally in U.S. equities this year and the role AI and tech stocks have played. Well, my next guest says Canadian stocks have been having a pretty impressive year in their own right, but without a lot of attention. Michael O'Brien is Managing Director and Head of the core Canadian equity team at TD Asset Management. He joins me now. That seems very on brand for Canada, just quietly doing its thing. I don't know if that was a thought, but tell me, you say when it comes to investing themes, AI has certainly sucked the air out of, I'd say, the media headlines and everything else in terms of what people are paying attention to. But the TSX is up 9% year to date. Yeah,
it's interesting. I mean, we've had, some people have been saying recently, like, what's wrong with Canada? Why is Canada not performing? Well, the fact is Canada is actually having a very solid year, like you say, underneath the radar screen.
Yeah.
But we're being measured against a giant right now in this moment where, the whole AI theme, AI thematic south of the border, and some of these truly phenomenal companies that are just posting, mind-blowing revenue and earnings growth right now. Mm-hmm. It's just hard for the Canadian market to really grab investors' attention when you're compared to that. So, right. So that's really it. Like, Canada is not having a bad year at all. Like, I think we're up 9% now, mm-hmm. just a little after the halfway point. So a good year is usually 10%. So
yeah, that continues.
So I think investors are going to be happy with their statement. It's just we haven't been the center of attention, but in a strange sort of way, that's actually a good thing.
Yeah.
We're not an overheated market. It's not an overvalued market. Just very workmanlike. Delivering the returns that investors are going to be happy about. In truly Canadian fashion. We just can't be jealous of the neighbor to the south that's having a pretty astounding year so far.
What about when you think about valuations? I mean, you talked about not having the maybe over-owned and overvalued, that we don't actually have that here right now too. So how do you see Canadian valuations right now?
So Canadian valuations, I would say they're not demanding. Mm-hmm. Big pockets of the market, you can always find exceptions.
Yeah.
There are some stocks that have run pretty hard that are looking a little extended, but broadly speaking, they're big, important parts of the Canadian market that are very reasonably priced today. Now, there is a reason for that, though, which is the economy has been pretty sluggish. Mm-hmm. We're probably going on a year and a half of the economy growing below trend. You're seeing that reflected in earnings growth that isn't spectacular. Dividend growth has slowed down as a result of that. So, I think the real key for the Canadian market to hit that next gear is, can investors find a reason to think that 2025 is going to be a better economic backdrop? Are the reasons to believe that earnings growth will be better next year than it is, 2023, 2024? So, that's what I'm sort of spending my time looking at.
I think it's going to depend obviously on the companies too, because within the Canadian, some service global economies, some service domestic, and so it depends who's leveraged which way.
Absolutely.
I know you've got some sectors and some names that you think are notable to talk about. So let's talk the first one. And this is energy, and you're highlighting CNQ, and tell me why on this one.
Yeah, well, I mean, the bright spot in the Canadian economy and the bright spot in the TSX year to date has been in that resource complex. And so energy obviously is a major part of that. I think the story there for Canadian Natural Resources and a lot of its peers, a lot of the big oil producers, it's not so much that oil prices are off the charts, it's that oil prices are at a very healthy level. And these companies have all kind of arrived at a stage, a maturity phase of their operations where they can generate very strong cash flows at these oil prices. And it's a very different mindset that we're seeing among the leadership teams at these companies, where it's very much focused now on returning capital to shareholders. So share buybacks, dividend increases. And so that's really what makes the energy producers stand out this year or differentiate themselves, is in a year where, broadly speaking, earnings growth isn't that strong across the Canadian market and dividend growth isn't that strong. This is one pocket of the market that you're seeing really outsized shareholder returns.
What about the materials side, and specifically you're highlighting here Agnico Eagle? Sure.
So materials that's sort of the second leg of that commodity stool.
Yep.
Materials and energy are about a third of the Canadian market, so a very important part of the TSX composite. Gold bullion, I think today hit an all-time high, if I'm not mistaken. Mm-hmm. A lot of the metals prices have been very solid, and it's not so much that demand is that strong, it's more, supply has not been supply has really been constrained from the last decade being so terrible.
Right.
So now all of these metals have kind of come back to prices that are very attractive for the Canadian producers, and you're starting to see some nice free cash flow. Agnico is one of our favorites in the gold space. We're really hoping that we're at a point now with the gold miners where you're going to see the margins really start to expand with the bullion prices. They were squeezed on expenses for a while the last couple of years. I think that's been worked through. So I think you should see some nice earnings growth out of this pocket of the market, the gold producers especially.
I guess they can keep those expenses down where they are and get the margin expanding. Reminder: do your own research. Rails, you've got CP on your focus right now.
Yeah, well, I think it's an interesting pocket of the market to talk about because rails have always been one of the bluest of the blue chip spaces in the Canadian context, CN and CP both. They've really kind of gone sideways for the last couple of years. We've had that very strange pandemic experience coming out of lockdowns, and everybody bought too many goods, and then you had to work down the inventory. So we've been in this strange, what people are calling a freight recession, where volumes for the rails have been very soft for the last couple of years. So again, this is a pocket of the market that the stocks haven't really been performing all that well, but as you look forward to 2025, if we get that improvement in the economic environment, these are one of those early cyclical names that should perform well.
And all those commodities have to get shipped out on things. Yeah. Banks, you've got a couple of names here. You're looking at Royal Bank and Bank of Montreal. Maybe tell me the difference between the two, what you see.
Yeah, the good and the bad of the picture right now. And the banks, that's sort of the third stool for when you really think about what drives the TSX composite.
Yeah.
The banks are that third huge traditional driver of the Canadian market, along with your commodities. And so what we're seeing right now is the banks are kind of, I would say investors are trying to get confidence to look past the rising loan losses we've seen so far. Whether that happens this quarter, next quarter, 2 quarters from now, that's really the game in the short term.
Yeah.
But as you can see, Royal Bank's been a good performer. Bank of Montreal hit some problems with its loan book the last couple quarters. That's fallen out of favor. That really just tells you that the banks still haven't quite cleared the bar for investor confidence. Hopefully what we're going to see is with interest rate cuts, a rate cutting cycle beginning in Canada. We'll find out next week if we get the second rate cut or not. If we can have reasons to look forward to a more benign macro backdrop in 2025, the banks would be real beneficiaries of that. So again, a huge, important part of the Canadian market that still has a lot of potential if the macro turns.
You talked about obviously the importance of resources here in Canada, and there's a few commodities you want to talk about, and just understanding, as the commodity goes, so do often the stocks that are the companies that manage that and mine that. So let's start with a chart of Brent, and this is a 5-year chart of Brent that you've brought in. Tell me what we're looking at here and what's notable.
Yeah, so what's notable is, prior to the pandemic, sort of that phase from 2014 to 2020, which isn't on the chart.
Yep.
That was a very difficult, very challenging period for the oil industry. And what you saw, that was when U.S. shale oil production was just going through the roof. So you had a real problem with supply. Management teams, particularly in North America, were incentivized to drill. And ultimately it crashed the prices for a prolonged period of time. So when we look at the chart today, it's not that oil prices are that high. 80, 85 Brent, $75, $80 WTI, the North American benchmark. Those aren't robust prices relative to that $100 average we saw a decade ago. What they are is a very healthy level for the North American producers, particularly the Canadian oil sands producers are going to generate a lot of free cash flow if prices stay in this range. So really the story on oil, it's not so much about demand. Demand hasn't been that strong. Mm-hmm. It's really about supply discipline. And so as long as the supply discipline holds, that's a very positive thing for the Canadian industry.
I don't have a ton of time, but are you concerned though about, if, rates get cut because there's a recession and things slow down, then you could sound, what's the downside on oil then? Yeah,
well, demand is always going to be a concern of investors. Yeah. Clearly a recessionary environment is not a positive. Yeah. Oil is, clearly could go lower. But is it going to drop back to those $40, $50 levels? I don't think so. And I guess the thing I would point to for that is if you look at where the largest source of supply growth came from the last decade, which is the Permian in
Yeah.
the United States.
It's offline now.
You know, it used to be the moment that oil prices hit $40, the drilling rigs would fire up.
Yeah.
Today, we've spent the better part of a year between 75 and 90, and drilling rigs have actually been falling. So you could say 80 is the new 40.
Got it.
So I think it's a different world now.
Interesting. Copper, we've got a 5-year look at copper, and again, not too dissimilar to what we saw in Brent actually, but tell me what you see here.
Yeah, a similar story, a very difficult decade that preceded it. Not a lot of new mines coming on, and
Yeah.
so we've now hit this point where supply is still constrained. The difference between copper and oil, though, oil people are looking at, you know, the world using less of it over the next 10 years. Copper, there's a lot of debate about the next 6, 12 months. How does China look? How soft is China? But to a man and a woman, the vast majority of investors are very bullish about copper's 5 to 10-year prospects, and that's around electrification. You know, they're riding those AI
Infrastructure building.
coattails,
Yeah,
data
yeah.
center build-outs. And so most investors have a very positive longer-term view. But again, just to state the obvious, $4.50, you know, $4.50 a pound for a copper producer in North America is a very solid price. So again, that resource part of the economy in Canada doing very well at these levels.
Interesting. It seems like these neutral rates, or not neutral, but just this almost like the base case is seeming more stable.
Well, and that's kind of the old expression, you know, the surest cure for high prices is high prices.
Yes.
You know, it's almost too much of a good thing, whether it's high oil prices, high copper prices. Substitution kicks in, demand gets destroyed, and it just undermines the whole thing. So frankly, for an investor, this nice sort of healthy equilibrium it's a much healthier backdrop for the companies.
Yeah, it probably draws more into that one area too. That's a great point. Gold bullion, 5-year look at gold bullion. This chart is a bit different as it starts to go up to the right here.
Yep, I'm pretty certain today it hit an all-time high. You can correct me
Yep.
if I'm wrong. But gold has been shining, so to speak. And so it's a little bit different than the conventional, you know, supply-demand fundamentals for oil, copper, these other commodities, because there's so many other drivers. There's interest rate movements, inflation, geopolitical tensions, real interest rate moves. Anyway, the long and the short of it is that I think the geopolitical backdrop and central bank buying has really pushed gold to a new level. And again, that is, you know, close to 10% of the TSX composite is in gold mining stocks. So with a backdrop like that, you know, that's a very healthy underpinning for that portion of the Canadian market.
Let me ask you, I've only got about 30 seconds, Michael, but if from a, you know, Canada as a place to invest standpoint, Canada has a bit of an image program in terms of foreign investors. Is that going to change, do you see, in the near future? Because I guess it's all contextual as compared to whom is when people have choices.
Well, and clearly when you're listening to the dialogue south of the border, you know, that's a much more aggressively pro-business attitude that we're hearing from, you know, certainly from the Republican candidate. So in Canada, you know, I would point to 2 huge infrastructure projects that are being completed now, which are kind of the exception that proves the rule. So the TMX Trans Mountain Pipeline expansion finally came on this year. It's now moving crude. That's a huge win for the Canadian oil industry. The LNG Canada facility, I just read the last weld has been put in place for the first train of LNG Canada, an enormous liquefied natural gas export project. So those would tell you that things can get done, but you look at how long it took, how much it cost, and how many other of these projects fell by the wayside. It's just one of those ways of saying Canada can do better. We need to be more welcoming for investment. Will it change? Well, there's an election, you know, probably 12 months from now, 15 months from now. We'll see what that holds. So that, you know, that could be a catalyst for changing the, you know, government attitudes toward business. We'll see.